Hello, everybody. Live from Peoria Heights, Illinois. It's the Enlightened Investor Show here, I guess.
Might be a slight delay, though, by the time this get out, but live right now.
Live right now. And, we listen to the voice of our subscribers, and they say, we want to learn about stagflation. So this episode is going to be on the return to stagflation. So we got four things we want to do today.
Can you define stagflation?
Yeah.
Thank you.
It sounds terrible, doesn't it?
Well, it's not a deer.
It's not a deer, right? It's not on sale for under a buck.
Right.
That's an inside joke, people. But stagflation it's a bad term for when the economy has a recession and inflation at the same time. Or you can think about it as unemployment and inflation go up at the same time. So we're going to talk a little bit about stagflation, the likelihood of a recession, the likelihood stagflation comes back. How do markets perform when there is a stagflationary environment or a recessionary environment? We got some good data on that. And then what adjustments should people make, Mike, to their portfolio? So some good stuff there. And so the last time we had stagflation was, we were both young bucks.
Young
bucks.
Yeah, young
you get
bucks.
that one?
Yeah.
1965 to 1982. Now, take a look at this, folks. Like in 1964, if you look back in time, you'll see that, the unemployment rate was at 5% and the inflation rate was at 1%. But throughout this period of recession and inflation, you saw that 1975, unemployment's up to 7, inflation's up to 12. 1980, unemployment's up to 7.5, and inflation's up to 13.5. So that sounds like some pretty rough times, Mike.
It was.
It was.
For sure, yeah. I can remember. I remember it briefly because I was just coming out of college, but I think money markets got close to 20%, didn't they, if I recall? You're the economist with all the numbers. But
yep, absolutely.
Yeah. But the inflation, the thing people don't realize, because people always say, well, I'll jump on that, but inflation was running that high as well. So the real returns were still probably negative or zero back then.
Yep. Got to watch. And we're going to show a slide here just a second on how inflation just crushes your nominal returns here. Right. So, what happens what's going on right now that people are clamoring for this whole recession with inflation, a stagflation. And you were listening, I think, to Larry Summers last night and a few other economists talking about this. And there's a lot of factors going on. Like we've got the war in Ukraine, the oil prices are sure they're up, labor shortages.
And we printed a lot of money in fiscal spending with the whole COVID crisis as well.
Yep.
And we did it on top back in 08, 09 on top of that as well. So
we did.
A compounding effect. So, hey, I want to mention this while you're talking because I got this out of the Wall Street Journal.
Yeah, go ahead.
Being I got the Economist with me today. So, and you're going to give us some of your numbers. They said that the Wall Street Journal poll, this is April 10th, polled for the next 12 months what they think the odds of recession were. And this is up from 18% in January. They thought 18% thought that we might have a recession the next 12 months. It's now up to 23%.
Yep. Incredible.
And I believe you're going to show us your numbers at 24. So
yeah,
I'm probably,
I kind of feel
throwing that out too soon.
Mike, I kind of feel proud of myself here. I feel proud.
Yes.
So the reason is if you go back and look at our forecast for 2022 videos, came back in December 2021, we said, quote, in 2022, recession probability is
Thank you.
12.7%. And I applied this little model. And you said, oh, that's cool. That's good. And then we said, watch out for the black swan event, right? This. And we didn't know the war was coming with Russia and Ukraine, but we remained vigilant. Well, here's my new model today. You said 23%, the economists are saying?
That's the number. I
say 24% chance in the next 12 months. So really, we're always up for a recession if, a black swan event occurs, but there has been elevation in recession probability. And I think that's why people are a bit kind of worried and upset.
Well, and also, let me add this, because the thing I see too, because you see it in the news, is that's the big word right now. In addition to inflation is recession now. Mm-hmm. And the key is, I don't think you want a knee-jerk reaction whether we're going to have inflation or a recession. If you've already got a plan in place and a portfolio that's well diversified, stay the course.
Stay the course.
But if you don't have a plan and you're not well diversified, it's time to really reevaluate that before the storm hits.
Absolutely. There's no doubt. And which person you'd think feels better and when they lay their head down at night? The person with a plan, right?
Sure.
Absolutely.
And the guys, I guess, that sell. Like you were mentioning, you knew someone that had sold recently, and That's great. I mean, if we do have tough times ahead, they feel like they've pulled a fast one on the market and they're ahead, but they got to get back in yet. So when do you get back in? Because the skies, I mean, if we do then get into a recession, they're definitely not going to do it at that point in time, and they're going to wait for the skies to part and become blue. And by then, the market's probably higher than when they got out. So now they stay out, and it compounds the problem.
It compounds. So. And what about those individual days that are like huge for?
Correct.
Those huge up days.
Comes fast.
How do you predict that? Right.
Sure.
So folks, again, like plans are a key for everybody in this world of investing. And the probability of recession's there, but it's always there. So hang in there.
Oh, hey, can I add one other number?
Oh, yeah, sure.
I'm sorry.
I'm interrupting you. It's a Mike thought.
Interrupting your talk. Well, I had these jotted down. It's like, I like to read a little bit. So Schwab had a source, Strategic Business Insights, they quoted this past week, that if you have a financial plan in place and that you obviously follow it and keep track of it and stay disciplined, in the long term, you end up having 2.7 times higher net worth. Now, I didn't look at the study to see what the time frame was, but I assume that's probably a lifelong time frame of having a plan, or at least a very long one. But I mean, that's an impressive number.
2.7x.
That's 3 times, basically, right?
Yeah, I mean, all around here, if we could 2.7x anything, right, we'd be pretty happy.
We're happy, right?
Happy. The producer would be happy.
Okay,
right?
so back to your. Sorry, hate to interrupt.
So anyway, this is good stuff. But there's some reasons why we're a little bit worried about recession, but I want to tamper that down just a little bit. Like, we've had some good job growth. Here's a slide here. It looks at that we've had 20 million jobs in the last a year and a half. And there's been an unexpected jump in consumer sentiment. This kind of surprised me. So I think people are going to continue to spend. The summertime's coming up. I think some folks are going to be taking vacations. Be looking for a solid summer spend. I mean, consumer spending 70% of the economy, Mike. So
they're getting out of the house, right? Everyone wants out.
Everyone wants out. The one thing I'll kind of preface is about recession chances is oil. Is that whenever you see oil shooting up to over $100 a barrel, that does raise some probabilities of recessions, because in the past several recessions we've seen oil prices spike up before then. But so we're hoping that this war doesn't prolong itself, and it doesn't spill over into food and fertilizers continually, and we can get back to normal activity.
Well, again, isn't this a lot of this is noise, right?
It is.
I mean, it's short term, and it's great if you're aware that this is all going to occur. Even if you knew that recession's going to occur, and you get out right now, again, it goes back to the point of getting back in. So the key is, we want people to ignore this noise, even though we're kind of making them aware of some of the topics that are here. Mm-hmm. We're not trying to say that for any reason they want to act on any of this.
Yep.
Unless they don't have a plan, or you're not well diversified.
Right. And and I think that's what our subscribers are telling us. So they want us to go over recession, stagflation. So let's tell them, and let's take a look at how. So if you guys are what happens to the markets when there is stagflation? So let me show you what happened from 1965 to 1982, the last time we had stagflation. This is nominal returns. You can see that overall, it was good to be in the market.
Explain nominal, please.
Oh, yeah. Okay, so nominal asset returns are returns without considering inflation.
Thank you.
Okay, so without considering the aggregate price increases. So, for example, total U.S. stock market yielded about 7.76% annualized return. Had a strong deviation, which means it could go up or down on any particular year. But the total return is about 283% for a long horizon. Notice, we were talking before shows that U.S. small value does very well. But also, if you diversified into that whole group, that's not a bad, there's some good asset classes there.
Right.
But watch this, ladies and gentlemen. This is the scary part. Real asset class returns. It's the same asset classes, but taking out returns, taking out inflation from those returns. So look what happens to large growth stocks, Mike. They've had this huge rally recently, and
the last decade.
And if we get hit by some, they were hurt during that.
Yeah, that's kind of more or less your
period.
NASDAQ. That's your Teslas, your Apple.
Yep,
et cetera.
Getting hammered.
Yeah.
And one asset class that does still do well is the small value. So just kind of consider that. We got this information from Interact FA. And then the last thing is, what adjustments should you make to your portfolio, given that given if stagflation does occur, what should a person do? So we had a couple ideas here. Number one is be diversified with ample exposure to maybe some small and large value. This is kind of what we do personally. It's not a recommendation. It's just what we do personally. And it's also expensive not to be in the market. A lot of people are running around fearful. I think the fear and greed index it's showing fear right now, Mike. So people are pulling their assets into cash. They're selling. But if you're holding cash, and right now inflation's at 8.5%, that's a big loss not to be in the market for a year. And what's the cost of timing? Like, so let's say you pulled your money, you pulled all your investments out into cash right now because you're scared. What's the cost of that? Potentially.
Well, I mean, what do you mean by what's the cost of
Well, like there's you miss out on the rally, right?
Well, of course, yeah.
So let's maybe even take a look at you gave me this slide right before we got into it. So there's several different market.
Well, those show the returns right after the recession. Mm-hmm. Yeah. So I mean, the point being is, if you're not already in and you're trying to catch those returns that occur right coming out of a recession, it's highly unlikely that if you were fearful going in, it's highly unlikely that you've gotten in before the sky turned blue and caught those returns, right?
Yeah.
Yeah.
Sure. And then the last thing is we think that, again, like invest in market index funds or ETFs. It's a way to participate in the growth of the overall market. And the overall market is incredibly upward.
Yeah, I think
upward to the
that
right.
data there, that was one of the slides I kind of slid on you, no pun intended there, towards
right
the
before
end of this.
showtime.
But, I mean, it basically just shows the economic cycle since almost 1926, I think it is, the last 100 years roughly. And the shaded areas show the different recessions that have occurred through time. Mm-hmm. And it's cyclical, and to think that you can time it, I mean, you look at it, it's very random and it's uncertain, and then there's a lot of factors that go into every recession. And the point being, if you take the longer view, if you're a long-term investor, capital markets are still going to reward you in a positive manner that's going to outperform inflation.
Mm-hmm. Mm-hmm. I'm still going back to that 2.7% higher returns if you have a plan.
Yeah, that was an interesting number.
That's amazing.
I may have to dig into that and read a little more of the facts and time frame, but still.
Yeah. Imagine that. You reading things?
Well, imagine, right? I don't send you anything at night, do I?
No. Yeah, I got stuff to do. But, well, folks, man, I hope you guys enjoyed this little discussion on stagflation, what you can expect. If we do go into stagflationary periods, it's tough on assets. It's tough on everybody.
Well, it's
right?
tough on us personally. I mean, I think the key is if you've got a plan, you're confident that it's going to play out for your goals. The key is staying disciplined, because there's so much noise. Again, I keep using that word noise, but think about it, the media has to sell this about talking about recession, talking about stagflation. Mm-hmm. And if it all occurs, yeah, but the thing is you can't knee-jerk react to every different economic event that's going to come along, because they're going to continue to come along.
So I think this is a great idea, like get a plan, put everything in place, then wait 5 years. Like if you go to sleep for 5 years, wake up and you'll be happy with your outcome.
Sure. But yeah, I think what we need to talk about in the future too is take a look at fixed income, because fixed income with inflation, that's a topic that
we haven't done a ton of that. Yeah.
Okay.
What do you think? Good?
Works for me. Stagflation.
All right, Buck.
Under a buck.
Take care, folks.